Time is 5:48 and it's time to talk your money here on Good Morning Quad Cities. First, let's take a look at how the stock market is doing. At the end of last week's trading, the S&P 500 was down nearly 6%. The Nasdaq and Dow Jones Industrial Average both dropped nearly 5%. Now, over the past few months, you've probably noticed that interest rates on credit cards, bank loans, and home mortgages have all been steadily rising. But consumers should expect those rates to climb even higher in the coming months. On Wednesday, the Fed raised the benchmark Fed funds rate by 0.75%, the largest single rate hike since 1994. Joining us is our financial expert, Mark Graboczewski from the Quad Cities Investment Group. Mark, good morning. Thanks for being here with us today.
Oh, good to see you again. Happy Monday to you as well.
Well, thanks. It's been a while.
It has.
Time to catch up. Now, understandably, people may not know a lot about the Federal Reserve and what's going on with these rates, so please walk us through the process.
I know for a Monday morning, it's really early to start talking about the U.S. Federal Reserve, so everybody just grab their big, giant bucket of coffee and we'll sort our way through this. But as part of its mandate, the Federal Reserve tries to manipulate, spending, investment, and now inflation to help, keep the economy moving along. And one of its main tools is the management of the benchmark Fed funds rate, which often serves as the basis for many other forms of debt. So when the Federal Reserve raises the Fed funds rate, you'll typically see interest rates on, as you'd mentioned, credit cards and bank loans, variable rate mortgages, and many other forms of debt also start to go higher. Now, back in March and April of 2020, Linda, the Federal Reserve slashed the Fed funds rate from, 1.75% down to near 0%. And the goal at the time, Linda, was that these ultra low interest rates would stimulate consumer spending and help boost the economy during the pandemic. But now, as we're all aware that inflation is so out of control, the Fed hopes that by raising interest rates, it forces consumers to cut back on their spending, and that reduced spending hopefully starts to apply some downward pressure on consumer prices.
Right, and we've already seen a number of interest rate hikes by the Federal Reserve. How many more should we be seeing in the coming months?
Well, ideally, when the Federal Reserve starts raising interest rates, it does so in these very gradual 0.25% increments. But because inflation has risen so high, so fast, the Fed is forced to become extremely aggressive in raising interest rates. Now, back in March, the Federal Reserve did raise the Fed funds rate just by 0.25% here. But then 2 months later, in May, the Fed raised the Fed funds rate, this time by 0.5%. Then on Wednesday, the Federal Reserve raised the Fed funds rate from 1% up to 1.75%. And this 0.75% rate hike here, Linda, was the single largest rate hike by the Federal Reserve going all the way back to 1994. But wait a second, we're not done yet with the Federal Reserve. Next month in July, the Fed is expecting another 0.5% rate hike. This is to be followed by 3 more quarter-point rate hikes by the end of the year and 2 more in 2023, most likely in the first half of the year. So after all is said and done, Linda, this 1.75% Fed funds rate is expected to double 3.4%, 3.5%. So there's a lot more rate hikes, unfortunately, coming down the road.
Wow, I'm going to bring up the dreaded R word, recession.
We don't like to talk about that.
I know, but we have to ask, what is the likelihood that we're going to see another recession?
There is tremendous concern on the future outlook for the U.S. economy. Now, nobody knows for sure if or when, the U.S. economy might dip back into a recession. Does the economy remain, just barely strong enough to avoid a recession? Or if we do go into a recession, will it be, short and mild, or will it be long and very severe? But it all goes back to those interest rate hikes that we just spoke about. To have that Fed funds rate go from the current 1.75% all the way up to 3.4, 3.5%, not over the course of 2, 3, or 4 years, but we're talking a very short, compressed window of time, and that places a tremendous strain on consumers, businesses, and ultimately, Linda, the U.S. economy.
And we should remind folks that the markets are closed today for the federal holiday, but we were talking during the break that they need a timeout.
They do. They need to go to their corner, come back tomorrow, and hopefully we see a little bit of a recovery in the stock market.
Great. Mark, as always, thanks so much for being
Great
here.
to see you again. Enjoy the rest of your day.
You too. Thanks so much.